Hello financial fans, welcome back to another stock analysis. Today we'll be covering AT&T stock ticker T. AT&T, short for American Telephone and Telegraph, is a multinational telecommunications company that offers a wide range of services to individuals and businesses. With a rich history dating back to the late 19th century, AT&T has evolved into a leading provider of wireless communication, internet connectivity, and digital entertainment solutions. Through its expansive network infrastructure, AT&T enables people to stay connected through mobile and fixed line services, offering voice, data, and messaging capabilities. Additionally, AT&T provides a high-speed internet service, enabling customers to access the digital world seamlessly. Furthermore, AT&T delivers a diverse array of digital entertainment options, including streaming services for video, music, and gaming, catering to the growing demand for immersive and on-demand content experiences. The company is currently sitting at a market cap of $114.35 billion, and in 2022 they generated a revenue of $120 billion. And the dividend yield is currently sitting at a very high 6.89%. 73% of the revenue generated through AT&T comes from communications, 24% from Warner Media, and remaining 3% from Latin America. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and light green, or bright green rather, will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone down over the years, going from $30.7 billion in 2013 to $29.5 billion in 2022. The EBIT growth is still 5.5%, meaning no change in the margin of safety. The margin of AT&T has gone up over the years, going from 23.88% in 2013 to 24.41% in 2022. The average margin growth is 1.83%, which is a 5% deduction from a margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone down over the years, going from $1.80 a share to $1.11 a share in 2023. This massive drop from 2021 to 2022 came from the spin-off of Warner Media. Because of this spin-off, of course, the dividend dropped during these years. This will then, of course, not be calculated into our dividend growth that we have calculated on average, which is still 1.83%, which is a 5% increase still in a margin of safety. This with a payout ratio sitting at 59.84%, which is no change in the margin of safety on our metrics. And the last metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get the debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for AT&T, this is just over 3 years, in this case a 339% debt to EBITDA ratio, which is a 5% increase in the margin of safety. The return on invested capital for AT&T is sitting at a very solid 10.7%, which is no change in the margin of safety on our metrics. Let's go look at the valuation models next to determine the intrinsic value of AT&T. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of AT&T going from 2014 to 2022. The average growth in their free cash flow annually during this period was 9.42%, and I'm projecting an expected growth rate in the future free cash flow of 3% over the next 10 years. With this percentage, we'll determine the future free cash flow for AT&T and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $288.2 billion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $137.2 billion. And then dividing this by the amount of shares outstanding, we get a discount cash flow price per share of $19.20 a share, which is a 19.92% upside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of AT&T going from 4 years ago to the current year. The average growth rate in this period in their dividends was of course minus 11% because of the spin-off. So I'm projecting expected growth rate still of 2% in their future dividends, because this was the amount they were increasing it for before the spin-off. I will be using, once again, a discount rate of 8.5% in this valuation. This gives us a dividend discount model price per share of $17.42, which is a 8.8% upside out of this model. The third model that we'll be using is Graham's devised valuation formula. In this model, we take a look at the earnings per share that AT&T is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of company with no growth is always sitting at 7. And looking at all of these metrics, we get a fair value out of this model of $22.80, which is a 42.41% upside out of this model. The next model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to AT&T, which in this case is Verizon. And we take a look at their stock price and their earnings per share. And this way we get to determine the average PE multiple in the industry, which in this case is sitting at 7. Also have to do to get a fair value out of this model then, is to multiply by the earnings per share of AT&T, which is sitting at $2.85 a share, giving us a fair value of $19.96, which is a 24.64% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 6.65%, while the current yield is sitting at 6.78%, indicating that it's currently slightly undervalued on this metric. Doing the same for the PE ratio, on average it has been sitting at 7.19, while the current PE ratio is sitting at 5.14, which is once again indicating that it's currently slightly undervalued on this metric as well, giving us a fair value of $19.35, which is almost a 21% upside out of this model. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for our Patreon link. Anyways, getting the self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at the final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $19.75. A margin of safety we've determined earlier, using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, deducting it by 5% for the margin growth, and adding another 5% for the dividend growth, leaving us with a 30% margin of safety. Applying this margin of safety, we get a fair value of $13.82, and with the current price of $16.01, we still get a downside of 13.67%, indicating that's currently a sell in our valuation. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.